radio for a really great future. We're talking real money.
Well, welcome once again to another one of those fun-filled Friday Q&A podcasts. Hi, everybody. I'm Don McDonald. Thanks so much for joining us for the Talking Real Money podcast on Fridays. Well, you may be listening at another day, but this goes up on Fridays. And you can send the questions that get used in this really, really easily. If you speak them, they get used on this podcast. So send those in at talkingrealmoney.com using the contact form, and then just record your questions. And they'll end up within a couple of weeks on the Friday Q&A podcast. Now, this is a relatively short one again, because I'm trying to keep some questions in abeyance for future podcasts. So more is better. If you want to call in some more, that'd be great. talkingrealmoney.com on the contact form. And let's just get to the first one.
Hey, you guys. Listen to your podcast, and you do recommend Avantis and Dimensional funds quite a bit. I'm just wondering if you guys receive any commissions of any sorts for recommending those funds. You kind of talked about other ones, but you're very specific about Avantis and Dimensional funds. So just wondering, I couldn't find that on your show notes or anything where it says you do or do not. So just wondering. Thanks.
Good question. And we do mention it from time to time, but maybe we don't mention it enough. We get nothing from Avantis or Dimensional. We have been suggesting Dimensional funds on one iteration or another of our podcasts clear back to, a long time ago, more than 2 decades, because they do something that nobody else up until that point did. And that was factor weighting their portfolios, where they would overweight small cap in value. And they built these truly global positions, but with an academic, evidence-based tilt to them. They didn't just slavishly follow an index, and they weren't trying to pick the right stocks at the right time. So nobody else was doing it at the time. And then somebody left Dimensional and went to American Century and started the Avantis ETFs, just as ETFs were getting started. And they followed that same kind of approach, but with slightly different screens. So the portfolios ended up being maybe a little more aggressive. And that was Avantis. So really, they're the only 2 companies that offer the incredible array of coverage that we want in a portfolio, from small to large, from value to growth, but with overweighting small in value, with an international component, with emerging markets, with all of the other asset classes that we want you to have in your portfolio. We don't have any other option. There's no one else that covers all those bases, so that's why they get mentioned so often. Most of the big companies are either pure indexes or purely active, truly active stock pickers, or a combination of those. So nobody really does what they do like they do it. And no, we don't get 1 red cent from them. Nothing. I don't think... Have they even, except at a conference where I think they fed us, I don't think they've even bought me a meal. So if we did get something out of them, Tom and I would be doing very, very well, though, because we've sent them, I know for a fact we've sent them, I can't prove it, but I know we've sent them billions of dollars. So we'd be very well to do, and we're just comfortable. We're just nice upper middle class people. Thanks for the question, though. I appreciate it. And remember, send them in at talkingrealmoney.com. Oh, and the other thing is that thanks to modern technology, I'll even make it sound like you're kind of on the air with me, like you're in front of a real mic, not at your computer or your iPhone, because we use AI to enhance your voice. So let's enhance somebody else's voice right now.
Hey, Tom and Dons. I was calling to get some guidance on some long-term planning for our kids. My wife and I are both 34. We have a daughter who is just short of 2 years old and 1 on the way. Unfortunately, our daughter was recently diagnosed with a neurological disorder. That means she would be dependent on us from now until she passes away. Thankfully, the lifetime that she expects to live is probably into their 50s or 60s. So naturally, we're worried about what happens to her if we pass away. We've heard about able accounts to start saving for special equipment or care, and then we've heard about third-party trusts. Can you help give some guidance on who we should talk to or what we should do to look into these things? Thanks.
Oh my gosh, I feel for you guys. There was such a case in my extended family, and I get it. And I can't tell you how important it is at this juncture to make sure you have someone, a specialist, to help you put these things together. That's where an attorney who specializes in special needs trusts is going to be really invaluable. This is where you really do need some expert guidance, and not from a financial advisor, but from an attorney, because you've got to navigate some tricky territory in making sure that her Social Security disability payments are protected. There are various kinds of special needs trusts. As you mentioned, there's the third party. There's the first party if the child has its own money. There is some second to die life insurance planning that you probably want to take. And there are also just some papers that need to be drawn up to make sure it's not just the financial support, but the care. So an ABLE account is just one tool. It's a good tool because you can put money into it and it doesn't affect your Social Security disability payments. And it creates a structure, but it's just a piece of the whole plan. And if you want to do this right, I absolutely would be remiss if I didn't tell you to go. If you have an attorney in the family, ask them if they can refer you to someone who really specializes in special needs, unless they truly specialize in it. But you need somebody who's good at it. You don't just want this haphazardly thrown together. Wow. Tough situation, but you guys are doing the right things. Thanks so much for calling. I appreciate it. Send your questions in at talkingrealmoney.com on the contact form, and here's our next one.
Hi, Don. My name's Tim. I'm down here in Arizona, and I was wondering about your guys' discussion of those all-in-one funds. You say they're really simplistic and easy to use. I'm sure that's during the accumulation phase, but what about when you want to start decumulating? I'm talking about VT or AVGE, a fund like that. What do you do to sell stocks in that fund when small cap value is way up and S&P is down 5%? It seems to me like you just sell the whole thing and you take a loss on the S&P. So by having a fund like that, wouldn't it be better to have that broken down into 3 or 4 different funds and take from those funds as they're up? And my next question is, does that fall under the optimization category or a critical thing as strategizing for decumulation? Thanks for your time. Bye.
I'm thinking that you're looking at a tax strategy. And I don't think your tax strategy is going to be all that important if you have a fund of funds during the accumulation phase. Because if you have a fund of funds for 10, 15, 20, 30, 40 years during accumulation, you're not going to have any losses. If you have losses, somebody messed up or the economy completely collapsed. So we don't believe in trying to overmanage in the decumulation phase either. We believe you should keep it simple. We are huge fans of taking the money out of the entire portfolio that you need to live on for the next month or 6 months or a year or whatever that period is. You take it out all at once. You don't try to pick the one that's the winner or pick the one that's the loser, which you can't really do with a fund of funds anyway. So it makes it just so much simpler. Take out your flat 4% plus inflation every year, or take out your flat 5 or 5.7%, as Morningstar says. Take that out every year, put it in a money market or a high yield savings account, and then live off of that. And don't worry about which account you might take it from. All you're going to do is make your retirement far more complicated. And you're going to have to go through this convoluted process of figuring out where to take it from and then rebalancing back to get your original proper balance. With having a fund of funds or a target date fund, sort of eliminates the need to do all of those permutations. So you just take it out. We're not looking to buy dividend payers in retirement or higher yielding in retirement. Just take it from your portfolio. Make it simple. It's this big brain. We want to overthink things, but it's not necessary. And any possible benefit it could provide is going to be so negligible. Really, likely, based on all the numbers we've looked at, so negligible that it's hardly worth dealing with unless you have, some sort of a massive multi-million-dollar, 8-figure, 9-figure portfolio. The tax advantages are going to be outweighed by the sheer simplicity, in my opinion. Thanks so much for your question. And I'm sad to say we're going to hit the last one here. Send in at talkingrealmoney.com. Here we go.
Hey, Don. This is Jeff in South Carolina. I love the show and never miss it. I've also attended the last few retirement sessions virtually and have learned a great deal from those. I am retiring from teaching in June at age 54. Don't worry, I have a second career that I'm transitioning into. It pays a little less than my current job. It's a 1099 position with no benefits, but I will have all the retiree benefits from my teaching job. My question's about my HSA. I've been having money taken from my paycheck to maximize my HSA. Those funds have been going to our state's HSA provider, HSA Central, which is not a great option. I opened an HSA at Fidelity and have transferred money from HSA Central to Fidelity to take advantage of their low fees and access to ETFs. I'm using the HSA as a triple tax advantage retirement account, and I pay for all of my medical expenses out of pocket, saving all the receipts to take distributions from the HSA without taxes or penalties when I need them in the future. In addition to my pension and compensation in my new career, I will likely be taking small amounts from my 457B the next few years to cover a gap in expenses. Is it worth taking a little more from the 457 to continue to fund my HSA at the maximum level, effectively creating a pseudo Roth conversion? I look forward to your thoughts, and thanks for all that y'all do.
This is another example of our big brains. Look at all the stuff we're thinking. This is actually pretty good thinking because you are, in essence, putting money into a tax-free account as long as you stay under the limits and using the 457 money on which you're paying taxes. As you said, it's the equivalent of taking those $457 or 403B dollars or whatever they might be dollars and moving those into a Roth account. It's the same net effect. So, yeah. And by the way, you got a good plan. And yeah, you're right. If I would have said, what are you going to do at 54? But you've got a plan for doing that. So good plan, good thinking, good use of your big brain. Enjoy the next chapter in your life when you get there. And it sounds like you are paying attention and planning for the various eventualities. And I commend you on that. Thank you all for listening. And again, if you have questions, you just go to talkingrealmoney.com and you'll see a button that says Contact Us. And on that button that says Contact Us, you say, I have a question. You can either type the question and then it'll go into Tom's giant tree pile, his wood chipper pile or whatever he calls it. If you speak them, though, into a microphone connected to your computer like this one, okay, not like this one. This one costs a lot of money connected to a computer. I don't want you to spend that kind of money. But, you can get a nice mic on your computer or talk it into your phone. Speak the question. You know where they end up. They're going to end up on the Friday Q&A podcast. And one more thing. We're part of a company called Apella Wealth. It used to be Vestry, and then we merged with Apella, and now we're part of Apella Wealth. And we have a slew of really great advisors who, of course, will work for you for a fee. And they're fiduciaries, 100% fiduciaries. They don't get any commissions from anybody, including Dimensional or Avantis. They don't even pay commissions. And you can meet with one of these, though, for free. You don't have to hire us. We'd love it if you hired us, but you don't have to. You can just, if you have some questions, you want your portfolio looked over, set up a meeting. And here's the best part. It won't cost you anything. Well, even better part is I can promise you there will be no high-pressure sales pitch. So go to talkingrealmoney.com, click on the button that says Meet an Advisor. I mean, Tom's not here. You can even put, I want to meet with Tom. He'll do it because he likes meeting with people. Thanks for listening. Thanks for participating. Thanks for telling friends. Thanks for helping make us one of the top 100 investing podcasts on a regular basis now, sometimes even top 50. Be great if we could be top 25, but we need your help to do that. And keep listening. I'm Don, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.